Let's begin with the truth that most traders refuse to hear. You don't lose because the market moved against you. You lose because you refuse to exit. That difference is everything. The market moving against you is normal. Refusing to exit is psychological. And psychology is what destroys accounts. Not strategy, not indicators, not the algorithm. You. Let's slow this down, because this lesson, if you truly absorb it, can change the trajectory of your entire trading career. Part 1. The anatomy of a bad trade. You enter a trade with conviction. You saw the setup, you calculated risk, you defined your stop, you felt confident. Price moves slightly against you. Your stop is close. You glance at the chart. Your chest tightens. It's subtle, but it's there. You tell yourself, it's just noise. It will bounce. I don't want to get wigged out. But something has already shifted. You are no longer observing. You are defending. There is a critical difference between observing and defending. An observer watches what the market is doing. A defender watches what the market is doing to them. One is objective, the other is personal. The moment trading becomes personal, your edge disappears, because edge requires clarity, and clarity requires emotional distance. When emotion enters, distance collapses. And what collapses with it? Your decision-making, your discipline, your account. Part 2. The neuroscience behind holding losers. Let's go deeper. The brain does not like being wrong. Being wrong is interpreted as threat, not logically, biologically. When price moves against your position, your nervous system activates, cortisol rises, heart rate increases. Your body prepares for danger. You are not just watching a red candle, you are experiencing perceived threat. And when the brain senses threat, it seeks to reduce pain. The fastest way to reduce pain? Delay confirmation. This is called pain avoidance bias. It is one of the most powerful forces in human psychology, and it is running inside you every single time you hold a losing position past your stop. Here is what is happening inside your brain at a neurological level. Your prefrontal cortex, the rational, logical part of your brain, is responsible for planning, risk assessment, and disciplined execution. That is the part that set the stop in the first place. But when the trade moves against you, the amygdala activates. The amygdala is ancient. It does not understand trading. It does not understand risk-to-reward ratios. It understands survival. And it interprets a threatened trade as a threatened self. So it floods your system with cortisol and adrenaline. And what happens to the prefrontal cortex under that flood? It goes quiet. Rational thinking is suppressed. Emotional reactivity takes over. This is why you can know exactly what you should do and still not do it. It is not weakness. It is neuroscience. But understanding it gives you power over it, because when you know what is happening inside your brain, you can create space between stimulus and response. You can pause. You can breathe. You can act from process rather than panic. That pause is where professional traders live. That pause is worth learning. Part 3. The detailed scenario. Let's walk through a trade in slow motion. You long a breakout. The structure looks clean. Momentum aligns. You enter. Within minutes, price fails and drops below your entry. You're down 0.8%. Your stop is 1%. You think, it's just a retest. Happens all the time. Price drops to -1%. Your stop is technically hit, but instead of exiting, you widen it. Let me give it room. Price drops to -2%. Now you feel heat. Your hands feel different on the keyboard. Your breathing is shallower. You open lower time frames. You search Twitter. You look for confirmation bias. You want someone to agree with you. You want validation. You are not trading anymore. You are negotiating with reality. Price drops to -2.5%. You refresh the chart again. You find an analyst who says the zone should hold. You feel temporary relief. False hope. Price drops to -3%. You finally exit. Exhausted. Defeated. 3 times your planned risk. Now frustration sets in, not just because of the loss, because you know you broke discipline. You watched yourself do it. You couldn't stop. That internal conflict, that awareness of your own failure, is heavier than the money lost. It carries into the next session, and the next, until you address it at the root. Part 4. The emotional stages of holding a loser. Let's name what happens emotionally, because naming it makes it visible, and visible patterns can be interrupted. Stage 1. Denial. This isn't real. The data is wrong. It will come back. This is the first defense. The mind refuses the incoming information. Stage 2. Rationalization. It's a liquidity grab. Smart money is hunting stops. This is just a sweep below the low. You construct a narrative, a new story to justify staying in. The story feels logical, but it is built on hope, not evidence. Stage 3, hope. It will reverse. It always reverses from here. I just need one more candle. Hope is not a strategy. Hope has no edge. But hope feels powerful in the moment. It feels like patience. It is not patience. Patience is holding a position because the thesis remains valid. Hope is holding a position because you cannot accept that the thesis is dead. Stage 4, emotional paralysis. You know you should exit, but you can't move. Your hand hovers. Your mind races. You feel frozen. This is the most dangerous stage because paralysis is expensive. Every second in paralysis costs you. Stage 5, capitulation. Finally, when the pain becomes unbearable, you exit, usually at the worst possible level, usually right before the market reverses, because the market has a cruel way of reversing the moment the last weak hand is shaken. And you were the last weak hand. Does this cycle sound familiar? It should, because it is universal among traders who have not yet addressed the psychological root of their losses. Part 5, the probability mindset. One of the most influential books ever written on trading psychology introduced a concept that changed how serious traders think about their craft. The concept is simple. Think in probabilities, not in certainties, not in hopes, in probabilities. Here is the core of that idea. The outcome of any individual trade is uncertain, always, no matter how clean the setup, no matter how aligned the confluences, no matter how strong your conviction. Any single trade can fail. But here's what changes everything. If you have a genuine edge and you apply it consistently, the outcome over a series of trades is statistically predictable. Not each trade, the series. This is the distinction most traders never grasp. They approach each trade as though its outcome is a referendum on their ability. A win means they are skilled. A loss means they are not. And so every loss becomes a crisis. Every drawdown becomes a collapse of confidence. Every stopped-out trade becomes evidence of personal inadequacy. This is the trap, and the escape from it is probabilistic thinking. When you truly internalize that any single trade is just one data point in a series, the emotional charge around each trade disappears. You stop needing each trade to work. You start executing each trade correctly. That shift from needing to executing is fundamental. It removes ego from the equation, and when ego is removed, exits become mechanical rather than emotional. The professional does not enter a trade and hope. The professional enters a trade and executes. Hope is for people who don't have a system. Execution is for people who do. Part 6, defense over offense. There is a philosophy shared by some of the most successful macro traders in history. It does not get talked about enough because it is not glamorous. It is not about finding the perfect entry. It is not about predicting the next big move. It is about one thing, defense. The idea is straightforward. Playing great defense matters more than playing great offense. What does defense mean in trading? It means preserving capital. It means honoring stops. It means accepting small losses before they become catastrophic ones. The traders who have survived market crashes, recessions, black swan events, they survived not because they predicted those events. They survived because their defense was so strong that no single move could destroy them. They cut positions decisively when those positions moved against them. They did not need to be right. They needed to survive. Because survival is the prerequisite for growth. You cannot compound a blown account. You cannot learn from a margin call. Surviving in trading means keeping your capital intact long enough to allow your edge to play out over hundreds of trades. One ego-driven loss can erase the gains from 20 disciplined trades. The greats understood this mathematically. He protected the downside with the same intensity most traders protect the upside. That asymmetry is the mark of a professional.
Part 7. Case Study. The Trader Who Changed. Let me describe a composite of real trader behavior. Call him David. David traded for 2 years. Technically skilled, beautiful setups, sound market structure analysis. But his account never grew. Some months up, most months flat or down. When he reviewed his trading journal, a pattern emerged. 90% of his losses were larger than his planned risk. His wins were precisely at his targets. His losses were consistently 2 to 3 times his stops. He was executing entries perfectly. He was executing exits terribly. The problem was not his system. The problem was his relationship with being wrong. David grew up in an environment where mistakes were punished harshly. Being wrong carried emotional weight far beyond the situation. So when a trade moved against him, it triggered something ancient, something from childhood. His trading losses were not just losses, they were echoes of past shame. He sought help outside of trading. He worked on the root of his fear of being wrong. He practiced acceptance, not as a trading technique, but as a way of life. His trading changed within 3 months, not his strategy, his psychology. His equity curves stopped hemorrhaging. His drawdowns became controlled. He became consistent. The lesson is not that David needed therapy. The lesson is that trading psychology is not separate from your psychology. They are the same thing. Part 8. The mathematics of discipline. Let's examine the numbers. Assume your system risks 1% per trade. Assume your win rate is 45%. Assume your average winner is 2%. Over 100 trades, that system produces positive expectancy. 45 winners at 2% each equals 90% gain. 55 losers at 1% each equals 55% loss. Net, positive 35% over 100 trades. That is a solid system. Now introduce ego. You stop honoring your 1% stop. Occasionally, just occasionally, you take negative 3% or negative 4% losses. Let's say it happens 10 times out of 55 losses. 10 losses at negative 3% instead of negative 1%. That is 20% of additional damage. Your positive 35% system is now producing 15%, and that is assuming you take only 10 oversized losses. Most traders with ego problems take far more. One oversized loss can undo a week of disciplined work. A month of oversized losses can undo a quarter. The mathematics do not lie. Consistency in loss size is just as important as consistency in trade selection, possibly more important, because a mediocre system with disciplined exits will outperform a brilliant system with emotional exits, every time. Part 9. Hope bias and confirmation bias. Let's talk about 2 cognitive biases that compound each other in losing trades. The first is hope bias. Hope feels powerful. Hope feels optimistic. Hope says, give it time. Trust the process. It will come back. But hope has no statistical edge. Hope is emotional anesthesia. It numbs the discomfort of being wrong, but it doesn't change the outcome. Markets don't reverse because you hope. They reverse because order flow shifts, and hope does not influence order flow. The second is confirmation bias. When you are in a losing trade, your brain actively seeks information that confirms you should stay. You look at Twitter. You find the one analyst who agrees with you. You zoom out to the weekly chart. You find one reason, any reason, to hold. You ignore the 10 reasons to exit. This is confirmation bias in its most destructive form. Professional traders are aware of this. They deliberately seek disconfirming information when in a trade. They ask, what would need to be true for me to be wrong? And when the answer appears in the chart, they act. Not after more searching, not after more justification. Now. That immediacy is discipline. That discipline is profit.
Natural flow. Human. Confrontational. Part 10. Averaging down. Doubling ego. Let's examine averaging down. You are down 2%. Instead of exiting, you add more. You tell yourself, better average, improved entry price, more exposure at a better level. But strip away the rationalization. The truth is, you are doubling down on ego. You are saying, I refuse to be wrong. And the market does not care. Averaging down on a losing position without a structural reason is simply compounding a mistake. It escalates risk exponentially. If price continues against you, the damage accelerates. You are now 2 times the size in a position that is already invalidated. One emotional decision becomes catastrophic. There are situations where scaling into a position makes sense. When price reaches a second planned level, when the thesis strengthens, when risk is defined and accepted. But that is planning. Averaging down to avoid being wrong is not planning. It is panic wearing the mask of strategy. Know the difference. Because one of them builds accounts, and one of them destroys them. Part 11. Identity and the trader. Let's confront ego directly. When you enter a trade, you attach identity to it. It becomes your idea, your analysis, your conviction, your thesis. So when it fails, it feels like rejection. The market is not just invalidating a setup, it is invalidating you. At least that is how it feels. So you defend. You widen stops. You average down.
you delay, you fight. But the market does not fight back, it just moves. And the longer you resist, the larger the damage. Professional traders have separated identity from outcome. They identify with their process. They ask, did I execute correctly? Not, did the trade work? If they executed correctly and the trade failed, they consider it a success, because process was honored. This sounds counterintuitive, but it is the foundation of long-term consistency. If your identity depends on being right, you will always struggle with losses, because losses are inevitable in trading. No system wins every trade. No trader is infallible. The question is not whether you will lose. The question is, how do you respond to loss? With acceptance and execution, or with ego and resistance? Your answer to that question determines your longevity in this market. Part 12. Practical tools for emotional regulation. Let's get concrete. What can you actually do differently? The first tool is pre-trade acceptance. Before you click buy or sell, pause. Say to yourself, out loud if necessary, this trade may fail. I accept that. If price reaches my stop, I will exit without hesitation. That statement primes your brain for acceptance. It preloads the response before emotion can interfere. Professional traders do this instinctively. They have already processed the loss before it occurs, so when it does occur, there is no shock, no negotiation, just execution. The second tool is journaling. After every losing trade, write 3 things. First, did I honor my stop? Second, if not, what emotion prevented me? Third, what will I do differently next session? This is not about self-punishment. It is about self-awareness. Awareness precedes change. Without a record, patterns stay invisible. Without visibility, patterns continue. The third tool is position sizing discipline. When you feel emotional before a trade, reduce your size. Not to 0, to half, or a quarter. Small size removes the emotional charge. Small size lets you execute mechanically. Then, as your emotional regulation improves, you can restore full size. The fourth tool is the pause protocol. When you feel the urge to widen a stop, set a timer for 2 minutes. Do not touch the trade. Just wait. Breathe. Observe. In most cases, one of 2 things happens. Either the trade hits your stop and you exit cleanly, or the 2 minutes passes and you realize you can still exit with discipline. The pause interrupts the automatic emotional response. It restores prefrontal cortex function. It gives your rational brain a chance to speak. 2 minutes. That is all it takes sometimes to save a trade or save your account.
Part 13. The defining metric. There is one defining metric in trading psychology: speed of acceptance. How fast do you accept being wrong? If acceptance is immediate, loss is small. Mental state is clear. Next trade approached neutrally. If acceptance is delayed, loss expands. Mental state deteriorates. Next trade is clouded by the previous one. Speed of acceptance is a skill. Like any skill, it can be developed. It is developed through repetition, through small, deliberate exits, through honoring your stop 50 times, then 100 times, until the neural pathway of stop hit exit becomes automatic. Until the prefrontal cortex fires before the amygdala can flood the system. That rewiring takes time, but it happens. And when it does, everything changes. Drawdowns become controlled. The equity curve stabilizes. Confidence grows, not from wins, but from trusting yourself to execute. That kind of confidence is unshakable because it is built on proof, not hope. Part 14. The market is neutral. The market is not attacking you. It is not testing your worth. It is not humiliating you. It is neutral, completely, absolutely neutral. It moves based on the aggregate of millions of participants, their orders, their algorithms, their fear, their greed. You are one participant. Your feelings do not move price. Your beliefs do not move price. Your hope does not move price. This is liberating if you let it be, because it means that every time price moves against you, it is not personal. It is mechanical. It is data, and data calls for a response, not a reaction. A response is chosen. A reaction is automatic. The drama exists inside you. You create the resistance. You create the delay. You create the oversized loss. Ownership is the beginning of control. When you own the fact that the problem is psychological, not strategic, you stop searching for better indicators. You stop buying new courses. You stop blaming the broker. And you start doing the real work, the internal work, the only work that ultimately matters. Part 15. Emotional fatigue and its ripple effect. Let's talk about something rarely discussed: emotional fatigue. Holding a losing trade does not just cost you money, it costs you mental energy. While you are holding a loser, you are not present. You are obsessing. You are checking the chart every 30 seconds. You feel tension in your shoulders. Your focus narrows to this one position, this one number, this one candle. When you finally exit, whether at your stop or 3 times your stop, you feel drained. That exhaustion carries into the next trade. You are depleted. Your patience is shorter. Your analysis is shallower. Your execution is reactive instead of deliberate. And so the one bad trade creates 2 bad trades, and 2 become 3. This is how drawdown spirals begin, not from a single catastrophic loss, from the cumulative fatigue of multiple ego-driven holds. One bad psychological decision ripples through your session, through your week, sometimes through your month. The solution is not just to exit your stops. It is to protect your mental energy with the same intensity you protect your capital. They are connected. Your mental energy is the engine of your performance. Deplete it, and everything suffers. Protect it, and everything improves. Part 16. Loss as operational cost. Loss is not humiliation. It is operational cost. Every business has expenses. A restaurant buys food that sometimes gets thrown away. A retailer orders inventory that sometimes doesn't sell. A technology company runs experiments that sometimes fail. These are not shameful events. They are the cost of doing business. In trading, loss is the cost of doing business. Specifically, your stop loss is a prepaid operational expense. You agreed to pay it when you entered the trade. When price reaches your stop, the expense is due. You pay it, you move on. If you cannot treat loss as expense, you will treat it as insult. And insult triggers defense. Defense triggers distortion. Distortion destroys edge. Change your relationship with loss, not to be careless about it, but to be businesslike about it. Measured, unemotional, consistent. Because the business of trading rewards consistency above all else. Not brilliance, not prediction, consistency.
Part 17. The shift. Now ask yourself something clearly. If every time your stop is hit, you exit instantly, how would your drawdowns look? How would your mental state feel? How much calmer would your sessions be? Imagine a version of yourself who exits immediately, every time, without hesitation, without negotiation, without widening. That trader's equity curve looks different. That trader's confidence is different. That trader's relationship with the market is different. They are not afraid of losses, because losses are small, predictable, controlled. They move through sessions with clarity. They approach each trade neutrally, because the previous trade, win or lose, is already processed, already accepted, already filed away. And the next trade begins clean. That is the life of a disciplined trader. It is available to you, not someday, now. The decision is made before price ever moves, at entry, when you define the stop, when you commit to honoring it. That commitment, made in a calm state before emotion can interfere, is your protection, your edge, your professionalism. Stop defending ego. Start defending structure. Stop negotiating with invalid setups. Start executing predefined exits. Stop protecting being right. Start protecting capital. That shift is maturity. That shift is professionalism. That shift is what separates the traders who survive from the traders who don't. Closing. Your growth as a trader begins with self-awareness. Not better indicators, not more screen time, not a new system. Self-awareness. The ability to see yourself clearly, to observe your own patterns, to catch yourself in the emotional stages, denial, rationalization, hope, paralysis, and interrupt the cycle. Before it costs you 3 times your planned risk, before it drains your energy for the week, before it compounds into a drawdown that takes months to recover. The traders who endure in this business are not the ones with the best setups. They are the ones who know themselves, who have done the internal work, who have faced their ego, their fear of being wrong, their need for validation, and chosen process over ego every single time. That choice, made repeatedly, becomes identity. And when discipline becomes identity, the market has nothing left to exploit. I'll see you in the next video. Until then, control your mind.